This week, the IT sector has been the talk of the town. On Monday, the Nifty IT index took a massive hit, dropping by about 4.7%. Every stock in the index was in red. Even worse, the Nifty IT index hit a fresh one-year low. Infosys emerged as its top loser, while TCS, HCL Tech and Wipro saw significant drops in their share prices. So what caused this free fall? In this episode of Informed Investor, we're going to delve deeper and decipher the reasons behind this fall. Merchandise exports, which were doing well in the first half of the last fiscal, seem to have lost steam in the second half. Headwinds from a slowing global economy are beginning to weigh more on merchandise exports. Yet, service exports, which are dominated by the IT sector, showed remarkable resilience. In this episode, we will also talk about the journey of service exports and its significance in India's economy. As India strives to become a manufacturing hub, Apple, the largest company by market cap, has played a significant role. While we've spoken a lot about why India needs Apple, let's try and find out how Apple needs India just as much. Let's begin. You're watching Informed Investor, the third umpire, and initiated by ResearchAndRanking. Indian IT sector has been facing some headwinds lately, and this has led to a lot of concern among investors. Aggressive rate hikes have increased the risk of a recession in developed economies like the US, the UK and Europe. Now, during a recession, companies usually cut their spending, including on IT expenses, resulting in delayed or cancelled orders and a shrinking order pipeline for the IT sector. Now, as Indian IT firms rely heavily on North America and Europe for its revenues, any impending slowdown in these regions is likely to change the demand environment. Moreover, the banking, financial services and insurance sector is the largest vertical for Indian IT services companies, contributing significantly to their revenues. Now, with recent events like the bankruptcy of Silvergate, Silicon Valley Bank and Signature Bank in the US and the merger of Credit Suisse and UBS in Europe, the sentiment in this sector has taken a hit. Now, with such sentiments already setting in, the Q4 performance that were released recently were weaker than expected. The big players in the Indian IT industry, that is Tata Consultancy Services and Infosys, didn't do as well as expected in the last quarter, which disappointed investors. Now, the March quarter is typically a seasonally weak quarter for Indian IT service companies, but the weaker than anticipated performance concerned investors when talks of recession were already trickling in. Now, TCS was first in the IT pack to declare its results this quarter. Now, in terms of revenue growth in constant currency terms, TCS saw growth of 0.6% sequentially, which was the worst performance by the company in 11 quarters. Now, TCS missed its estimates from all fronts, including revenue, EBIT growth, margin growth, and PAT growth. Now, Infosys was again another shocker to the market as it missed its estimates on all fronts. And this miss was more pronounced than TCS. If you see, the companies didn't see a year-over-year declaration in its revenues or significant decline in its margins. It just didn't meet the estimates of analysts. Now, coming to management commentary. The management commentary of IT companies in the previous quarters was largely upbeat on the demand outlook, even as the broader global economic trends were subdued. However, the management of these companies are recognizing the slowdown in decline. Take an example of Infosys. In its earnings call, it spoke about how some of its clients are slowing down projects across telecom, retail, and financial services. It also believes that the environment they're dealing with right now is one filled with uncertainty. Now, even TCS has cautioned about customer sentiment across BFSI, retail, and technology services. Moreover, it mentioned how there is anxiety around the stability of the banking sector. Now, we see how the management commentary from the top two IT service companies was marked with a sense of caution regarding the present customer sentiment across various verticals. Now, after they delivered a weaker than expected fourth quarter earnings and gave a cautious commentary on trends in the immediate future, several domestic and foreign brokerage firms slashed their earnings estimates and price targets of Tata Consultancy Services and Infosys. Now, all of these factors have dragged down the Nifty IT index. The stock market has reacted, factoring in the slowdown. Having said that, it's important to note that the Indian IT sector has always been resilient and has a long way to go. While the macro uncertainty is weighed on a number of clients, digital spending will continue. Analysts believe that after a few quarters, the sector will grow and recover rapidly. Now, as a long-term investor, it is important to remember that there will always be some headwinds in the near term, but these are just hiccups. The Indian IT sector has a bright future ahead and there's a lot of potential for growth. Now, if you want to know more, we have covered the trends and growth of the IT sector and the factors that will aid its future growth in one of our Third Empire episodes. Do watch it. Now, if you're wondering just how important the IT sector is, let's take service export as an example. Now, the sector contributes significantly to the country's service exports, which is a testament to its importance and potential for growth. Now, first, let's try to understand how trade is done. Trade is done in two ways: merchandise or goods, which includes items such as clothes, fertilizers, cereals, chemicals, etc., and services, which includes software, consulting, research and development, etc. Now, the overall trade of exports, which include both services and merchandise, crossed a record figure of $770 billion in fiscal year 23 compared to $677 billion in fiscal year 22. Now, the trade deficit, however, for the same period jumped from $83 billion to $122 billion in fiscal year 23. Now, India's net exports in goods are usually negative due to oil and gold dragging it, but our net exports in services have been traditionally high. Now, currently, India's merchandise exports have been hampered by the slowdown in major economies brought on by the conflict in Russia-Ukraine, rising energy and other commodity costs, inflation, and monetary tightening in major economies. If you look at the export breakup, merchandise exports rose only a mere 6%, but service exports rose 26.7% to an all-time high. Now, let's dwell deeper into the story of India's service exports, which have in the recent years grown tremendously, making this one of the lifelines for the Indian economy. Now, when we look at the 11-year performance of service exports, India's service exports rose from $142 billion in fiscal year 12 to about $322 billion in fiscal year 23. Now, the pandemic, demonetization, the Russia-Ukraine war all had a significant impact. However, the services sector has shown resilient in the face of such economic disruptions. Now, this is all possible because of the services industry, which has grown remarkably and has been the dominant sector in the contribution to exports. The service industry is the primary growth engine contributing to India's economy in terms of both growth and size. With this resilience, service exports now account for more than 40% of our total exports. Now, this impressive growth can be attributed to India's skilled and cost-effective labor force, which allows for importing services from India to be cheaper than sourcing them domestically. In fact, service exports have surged to a record-breaking 9.9% contribution to India's GDP in the last quarter, surpassing even pre-pandemic levels. Now, it's clear that the service sector is powering India's economic growth and creating a robust ecosystem. Additionally, with more service-related exports, the Indian economy could benefit with increased foreign exchange reserves, protecting us from any external risk. It could lead to ample job creation and also attract foreign investments. Now, as we spoke about this earlier, Indian exports is leading with IT services contributing 46% of service exports, but another trend is emerging, and this one is the business services, which makes up about 24% of the service exports. Now, the business services includes categories like accounting, audit, R&D, quality assurance, and management consulting. Now, another trend emerging is the setup of global capability centers. These are offices set by large multinational firms that provide services like IT, research, and analytical support to the parent companies. Now, India currently hosts about 40% of the world's GCC, and this will only go upwards. Now, we see India has great potential and capability in service exports. Apart from IT services and business services, there is still ample opportunity in sectors such as finance, medicine, education, and law. Having said that, the government has massive programs to make India a manufacturing hub, but very little attention is paid towards its services. vast subsidies and tariff protections are offered to attract manufacturing companies to shift from China to India. But service exports are soaring without subsidies or tariff protection. Now, despite Atmanirbhar Bharat and the production-linked incentive scheme, India accounts for 1.8% of world merchandise export but over 4.7% of world service exports. Now, don't get us wrong. In the long run, the PLI scheme, Make in India program and shifting demand from China all augurs well for India's merchandise exports economy. Now, these initiatives are synonymous with the phrase India will be the next China, and these schemes are also bearing fruit. If you're someone who reads news every day, you would know Apple's news are dominating headlines. Now, it could be about Apple expanding its production in India, about its investments in exports. It could also be about Apple creating jobs in the country. Now, the news is about Apple launching 2 new stores in India, one in Mumbai and the other one in Delhi. Now, till a few years ago, we had to rely on resellers and e-commerce marketplaces to purchase Apple products. Now, have you wondered why there was no official Apple store in India? Let's talk about this. Imagine a tech giant like Apple, known for its sleek designs and innovative technology, facing a unique challenge in one of the world's largest markets. India, a country with a population of over 1.4 billion people, has strict regulations on foreign direct investments in retail. Apple had been eyeing the Indian markets for years but was held back by the requirement that they source 30% of their products locally. However, in 2018, the Indian government relaxed this clause, allowing Apple to slowly ramp up its sourcing from India over a 5-year period to reach 30%. Now, it's a fascinating tale of a global brand navigating a very complex regulatory landscape in pursuit of growth in one of the most promising markets on the planet. Now, Apple has launched 2 official stores. Tim Cook was seen inaugurating these stores, he was seen meeting the Prime Minister, he was also seen eating vada pav with Madhuri Dixit and watching an IPL match. It's no surprise that India has become a huge focus for Tim Cook and Apple. Let's understand why. Now, firstly, India has a large population and a growing economy. This presents a huge opportunity for Apple to increase its market share by offering its products and services in the country. Secondly, Apple has less than 5% of the smartphone market share in India, which is much lower than its market share in other major markets like China, the UK, the US, and Japan. This means that there is a lot of room for Apple to grow in India and increase its sales. Now, as the crowds at Apple's newly launched stores demonstrated, the country has become a growing consumer of Apple's gadgets. Moreover, Apple's sales in India are relatively low compared to its sales in other economies. In 2022, Americas and Europe contributed about 43% and 24% of sales respectively, while China and Japan contributed about 19% and 7% respectively. On the other hand, India is barely there yet. In fact, India is reported in a category with other markets called Rest of Asia Pacific, which account for only 7% of sales. Now, this highlights the huge potential for Apple to grow its revenues. Now, Apple sees India not just as a large market, but also as a global hub for manufacturing and innovation. Currently, most iPhones are assembled in China, which has caused some problem over the past few years due to trade tensions and supply chain disruptions. Now, India could be a significant manufacturing hub for Apple as the company is looking for non-Chinese manufacturing options. Now, India's government is also eager to work with Apple to make this possible, and which could also benefit both the parties. Overall, India presents a huge opportunity for Apple to increase its market share and also to explore manufacturing options outside of China. This is why Apple's CEO's visit to India and the opening of new Apple stores in the country is a significant step towards achieving these goals. While I say this is me, Merlin Zana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.